Hello and welcome back to Money Mindset Hub, your home for navigating the evolving world of finance and building a stronger financial future. I'm your host, Raul Sofa. Remember the crypto roller coaster, the dizzying highs, the stomach-churning lows? For a while, it felt like maybe the mainstream buzz had faded, relegated back to the niche corners of the internet. But what if I told you that billions, yes, billions with a B, have just poured into Bitcoin in a way that signals something significant might be shifting? This month, May 2025, we've witnessed a staggering $3 billion flow into Bitcoin exchange-traded funds, or ETFs. That's not just a trickle, it's a torrent. And it begs the question, is this the moment crypto steps firmly back into the mainstream investment spotlight, perhaps for good this time? Whether you're a seasoned investor, just starting your financial journey as a young professional, or simply curious about where the world of digital assets is heading, this episode is for you. Today, we're unpacking the Bitcoin ETF boom. We'll explore what these ETFs actually are, why they're suddenly attracting so much capital, what it means for Bitcoin and the broader market, and crucially, what you need to consider if you're thinking about getting involved. Forget the hype and the headlines for a moment. Let's get down to the fundamentals and understand this potentially pivotal shift in the investment landscape. Stick around. All right, first things first. We're hearing Bitcoin ETF everywhere, but what exactly is it? Let's break it down simply. Many of you are likely familiar with traditional ETFs, exchange-traded funds. Think of them like a basket holding various assets, maybe stocks from a specific industry like tech, or bonds, or even commodities like gold. You buy a share of the ETF and you get exposure to everything inside that basket. They trade on regular stock exchanges just like shares of Apple or Tesla, making them super accessible. Now, apply that concept to Bitcoin. A spot Bitcoin ETF, and that spot is important, we'll touch on why, holds actual Bitcoin. When you buy a share of a spot Bitcoin ETF, you're essentially buying a claim on a tiny fraction of the Bitcoin held by the fund manager, like BlackRock, Fidelity, VanEck. Many big names are in this space now. So why is this such a big deal? Why not just buy Bitcoin directly from an exchange like Coinbase or Kraken? Well, for years, direct crypto investment presented hurdles for many people, especially traditional investors and institutions. One, complexity. Setting up accounts on crypto exchanges, dealing with digital wallets, private keys, seed phrases, it can feel daunting and technically complex for beginners. Two, security concerns. Horror stories of hacks, lost keys, and exchange collapses made many wary. While self-custody gives you full control, it also means full responsibility. Three, regulatory uncertainty. For a long time, the lack of clear regulation kept many institutional investors and even cautious retail investors on the sidelines. Traditional financial advisors were often hesitant to recommend direct crypto investments. 4. Accessibility. Many people prefer managing all their investments through their existing brokerage accounts, like Schwab, Fidelity, or Robinhood. Buying Bitcoin directly required stepping outside that familiar ecosystem. Bitcoin ETFs solve many of these issues. You buy and sell them through your regular brokerage account, just like any stock. The ETF issuer handles the complexities of buying and securely storing the actual Bitcoin. It operates within the regulated framework of traditional stock exchanges. Think of it like this. You could buy physical gold bars, worry about storing them securely, insuring them, and finding a buyer when you want to sell. Or you could buy shares in a gold ETF, where a fund manager handles all that, and you just trade the shares easily on the stock market. Bitcoin ETFs offer a similar convenience for Bitcoin exposure. It's important to distinguish these spot ETFs from the earlier futures Bitcoin ETFs. Futures ETFs track the price of Bitcoin futures contracts, which are agreements to buy or sell Bitcoin at a future date. They don't hold actual Bitcoin. Spot ETFs, the ones causing the current buzz, do hold the underlying Bitcoin, which many investors see as a more direct and pure form of exposure. The approval and launch of these spot ETFs, particularly in the US market over the past year or so, was a watershed moment. So, we understand what these Bitcoin ETFs are. Now let's really dig into the headline that's turning heads. $3 billion flowing into these funds just this past month, May 2025. This isn't just steady growth. Analysts are calling it a significant resurgence or rebound in inflows, especially after maybe a slower pace earlier in the year or late 2024. It signals renewed conviction. Where is this powerful wave of capital coming from? It appears to be a potent mix of factors, building layers of confidence on top of the foundation laid when these spot ETFs first launched. Let's break down the key drivers. 1. Institutions moving beyond caution. This is arguably the most significant factor. Remember the initial wait-and-see approach from big money? That phase seems to be shifting towards active, calculated investment, broader participation. We're seeing evidence, including comments from executives at top ETF providers like BlackRock, that it's not just niche hedge funds anymore. Larger institutional clients and the wealth management platforms that advise them are increasingly allocating funds. These players often require lengthy due diligence, and it appears many have now given Bitcoin ETFs the green light. Future potential driving. Present action. There's also significant buzz around the possibility of the major US wirehouses, giants like Merrill Lynch, Morgan Stanley, Wells Fargo, and UBS, potentially offering these ETFs later this year. While they aren't fully on board yet in May 2025, the anticipation of these massive platforms entering the market likely fuels current inflows as other institutions and advisors get positioned. Global validation. Adding to the legitimacy, reports have surfaced of sovereign wealth funds, government-owned investment funds like Abu Dhabi's, taking substantial positions in these ETFs. This signals a high level of conviction from globally significant investors. Leading funds attract more capital. Established ETFs from major players like BlackRock, IBIT, and Fidelity, FBTC, continue to capture the lion's share of inflows, benefiting from their brand recognition, scale, and proven track record since launch. Success breeds further success here. 2. Strong market momentum and psychology. You can't ignore the power of positive price movement and market vibe. Bitcoin's upward trend. Bitcoin itself has demonstrated significant strength lately. As we speak, in early May 2025, it's trading confidently near the $95,000 to $96,000 range, challenging the critical $100,000 psychological barrier. This resilience, especially after periods of consolidation, signals underlying strength to traders and investors. Success fuels interest. Rising prices naturally draw attention. Positive performance creates a self-reinforcing cycle. Higher prices lead to more media coverage, increased investor interest, both retail and institutional, driving more ETF inflows, which can further support the price. The approach towards 100K is a major focal point that could easily ignite more widespread interest, or FOMO, navigating uncertainty. Bitcoin seems to be charting its own course to some extent, showing resilience even amidst broader economic uncertainty or mixed signals in traditional markets, catching the eye of analysts looking for assets that might behave differently. 3. Growing appeal as digital gold. The narrative of Bitcoin as a potential hedge or alternative store of value is resonating strongly in the current climate, seeking alternatives. With ongoing economic questions, discussions about potential stagflation, and traditional hedges like gold performing strongly, investors are actively searching for diversification and ways to protect purchasing power. Bitcoin's mathematically fixed supply makes it an attractive candidate for this role in the eyes of many, and ETFs offer a simple, regulated way to gain that exposure. Favorable macro wins. Looking ahead, many market participants anticipate potential central bank policy shifts like interest rate cuts later in the year. Such moves could make holding traditional cash or bonds less appealing, potentially pushing more capital towards alternative assets like Bitcoin. 4. Tightening Bitcoin. Supply, basic economics, supply and demand, is also playing a role, particularly on the supply side. Coins moving. Offline. On-chain data watchers consistently point to a trend. More Bitcoin is being withdrawn from exchanges and moved into long-term storage, cold wallets. This reduces the readily available pool of Bitcoin for sale. Impact of demand. When the available supply shrinks, new demand, like the billions flowing into ETFs, has a potentially greater impact on price. It suggests current holders are confident in future price appreciation and aren't eager to sell, creating a tighter market. The effects of the 2024 halving, which reduced the rate of new Bitcoin creation, also contribute to this long-term supply constraint narrative. 5. The foundation, easy retail access. Finally, we can't overlook the bedrock driver enabling much of this: democratized access. While big institutional flows capture headlines, the simple fact that almost anyone with a standard brokerage account can now easily buy Bitcoin exposure remains a powerful, continuous source of underlying demand. This ease of access for everyday investors and young professionals provides a constant base upon which these other factors build momentum. So it's not just one thing, it's the growing institutional confidence meeting positive market momentum amplified by a compelling digital gold narrative in uncertain times, layered over tightening supply dynamics, all accessed easily through the ETF structure. This $3 billion surge in May 2025 really underscores how Bitcoin, via these regulated ETFs, is becoming deeply interwoven with the traditional financial system. Okay, multi-billion-dollar flows and institutional adoption are interesting, but let's bring it back to you, the aspiring investor, the young professional building wealth, the curious beginner. Why should you pay attention to Bitcoin ETFs? Firstly, accessibility. This is perhaps the biggest takeaway. If you've ever felt locked out of crypto investing because of the technical hurdles, ETFs tear down that wall. If you have a standard brokerage account, you likely already have access. It's as easy as buying a stock. Secondly, familiarity and regulation. Investing through a regulated ETF on a traditional exchange using your existing broker provides a layer of comfort and familiarity that direct crypto investing often lacks. You're operating within a known financial system with established investor protections, though these don't protect against market losses, of course. Thirdly, portfolio integration. For those thinking about diversification, ETFs allow you to potentially incorporate Bitcoin exposure into your overall investment strategy seamlessly. You can see your Bitcoin ETF holdings right alongside your stocks, bonds, and other ETFs, making portfolio management and tracking simpler. However, and this is crucial, it should be considered a speculative part of a portfolio for most people due to its volatility. Fourthly, simplified taxes potentially. Tax reporting for direct crypto transactions can sometimes be complex, tracking cost basis across different wallets and exchanges. While you still need to report gains and losses from selling ETF shares, the process is typically more straightforward and aligns with how you report other stock or ETF transactions. Your broker will usually provide the necessary tax forms like a 1099-B in the US. Finally, exposure to potential growth with a big caveat. Let's not sugarcoat it. Bitcoin is volatile, but it also represents a novel technology and a potential store of value or digital commodity that could see significant appreciation over the long term. ETFs offer a regulated way to gain exposure to that potential upside if you understand and can tolerate the inherent risks. This isn't a guaranteed path to riches, it's exposure to a high-risk, potentially high-reward asset class. For young professionals especially who often have a longer investment horizon, understanding new asset classes and investment vehicles like Bitcoin ETFs is part of building a robust financial literacy. Even if you decide it's not for you, knowing why puts you in a stronger position. Now, before you rush off to your brokerage account, it's absolutely critical we talk about the risks. The $3 billion inflow is exciting, but excitement shouldn't cloud judgment. Volatility is king. Buying a Bitcoin ETF doesn't magically make Bitcoin less volatile. The price of the ETF will mirror the often wild swings of Bitcoin itself. If Bitcoin drops 20%, expect your ETF shares to do roughly the same. You must have the stomach for potential sharp declines and not invest money you can't afford to lose. Market risk. Like any ETF, Bitcoin ETFs are subject to overall market sentiment and economic conditions. A broad market downturn could pull down even Bitcoin ETFs, regardless of crypto-specific news. Not your keys, not your coins. This is a fundamental concept in crypto. When you hold Bitcoin directly in your own wallet, you control the private keys. You truly own it. With an ETF, you own shares representing Bitcoin held by the custodian, the issuer. You're trusting that custodian to securely hold the underlying asset. While these are reputable institutions, it's a layer of counterparty risk that direct ownership avoids. You can't, for example, take your ETF shares and send them as Bitcoin to someone else. Expense ratios, fees. ETFs aren't free. They charge an annual management fee known as the expense ratio. While competition has driven these fees down for Bitcoin ETFs, some are quite low, they still eat into your returns over time. Always compare the fees of different Bitcoin ETFs. Regulatory uncertainty, still. While spot ETFs are approved in some key markets, the global regulatory landscape for crypto is still evolving. Future regulations could potentially impact Bitcoin's price or the operation of these ETFs. Concentration risk. If you invest only or heavily in a Bitcoin ETF, your portfolio is highly concentrated and exposed to the specific risks of a single asset. Diversification across different asset classes remains a cornerstone of sound investing. Investing in a Bitcoin ETF is simpler, yes, but it doesn't eliminate the fundamental risks associated with Bitcoin. Do your own research, DYOR, understand what you're buying, assess your personal risk tolerance, and never invest more than you can afford to lose. So, what have we learned today? First, spot Bitcoin ETFs have fundamentally changed the game for accessing Bitcoin exposure, making it much easier and integrating it into traditional finance. Second, the recent $3 billion inflow in May 2025 signals renewed and potentially broadening interest, from retail investors enjoying easier access to institutions growing more comfortable. It suggests Bitcoin is cementing its place, at least for now, in the wider investment conversation. Third, while accessible, these ETFs carry the inherent volatility and risks of Bitcoin itself, plus considerations like fees and custody structures. Convenience doesn't equal safety. What should you do with this information? 1. Educate yourself. Further, don't stop here. Read about the specific Bitcoin ETFs available, compare their fees, custodians, and track records if available. Understand the difference between spot and futures ETFs if both are accessible to you. 2. Assess your risk tolerance. Honestly evaluate if you can handle the potential sharp price swings. How would you feel if your investment dropped 30% or more in a short period? 3. Consider your portfolio. If you decide to invest, think about how it fits into your overall strategy. For most people, it should likely represent only a small, speculative portion of a well-diversified portfolio. Don't go all in. 4. Stay informed. The crypto and ETF landscape is constantly evolving. Keep learning. Keep listening to credible sources. The world of finance is dynamic. New technologies and investment vehicles emerge, challenging old norms. Bitcoin ETFs are a prime example of this evolution. Whether they are right for your money mindset is a personal decision, but understanding them is becoming increasingly important for anyone serious about navigating the modern investment landscape. Stay curious, stay informed, and keep building that financial future. What are your thoughts on the Bitcoin ETF boom? Are you considering investing or staying on the sidelines? Let us know in the comments below. We love hearing from the Money Mindset Hub community. And if you found this episode insightful, please give it a like. It really helps the channel. Make sure you subscribe to Money Mindset Hub for more episodes on navigating finance and investment. And don't forget to hit that notification bell so you never miss an update.